The bank of mum and dad is almost bigger than Suncorp. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee, let's have a look at this article discussing, written by John McCarthy, discussing how the bank of mum and dad almost outstrips Suncorp in first home buyer loans. Just think about that. Now, I completely agree with this. If you're a parent and you've got children that are trying to get into a house and you've got money just sitting there doing nothing and you can afford to give or lend to family members, to your children, nothing wrong with that. What interest are you getting in the bank? Pretty much nothing. If you can afford to do it, help your family. That's what they're there for, because they should be there to help you when you need it too. What scares me is when mum and dad sign on as guarantors to loans or put their own house up as collateral. That's the scary thing. Or go into debt and then give it to their kids. So let's look at this article. The spiraling cost of housing has meant that many first home buyers were borrowing as much as $89,000 from their parents, according to Data Finance Analytics. Is that Digital Finance Analytics or DFA? It found the bank of mum and dad was among the top 10 lenders in Australia, just behind Suncorp, and one place ahead of the Bank of Queensland. So mum and dad are ahead of the Bank of Queensland, everyone, with about $29 billion being loaned out to the next generation, and in many cases, it was in the form of loan guarantees. That's the issue there, the loan guarantees, everyone. That's what scares me more, because then if you give them money, the kids go under and they lose it, there's still a chance you might get it back, but you may not wind up on the streets if it's something you can afford. It's like an investment, like anything else. But if you've guaranteed a loan for someone else, they go under, then you could go under as well. Then you could lose your own home. And you don't have the same time frame to rebuild again. The totals are a big leap from just over a decade ago, when only about 3%, so 10 years ago, of first-time buyers received funds from their parents, and the amount averaged around $23,000. So from 23 to 89 grand. It just shows you how crazy this housing market is, how unaffordable it is to get in. The boost had most likely blown out because of the escalating prices in Sydney and Melbourne, according to Canstar financial expert Steve Mickenbacker. But he said there was a big difference in attitudes between millennials and baby boomers. He said only about 14% of baby boomer parents believed they had an obligation to help buy a property, but 33% of millennials believed their parents had an obligation to help them buy a property. So, I mean, no one is required to help you buy a property at all. It is an insane act of generosity. If you want to stash something away, so hopefully, if necessary, you can provide that to your children, that's fantastic. That is an achievement and something to be proud of, but they should not expect it. So what this is saying is 33% of millennials are entitled. What do you think about that one, guys? You know, let me know if you agree on that. 33% of millennials are entitled. Is that accurate? Kind of feels it, doesn't it? So there are going to be some pretty disappointed people out there, he said. He said the discrepancy was because a lot of baby boomers have been bombarded with news that they did not have enough to fund a comfortable retirement. That's a good point too. I mean, you keep hearing that again and again and again. Now, I've been looking into the Barefoot Investor because I didn't really know anything about him. And he's like the Australian version of Dave Ramsey, but he has a little bit of a different take on retirement. And he says you don't need that much in your super, as long as you can depend on the pension as well. They're approaching retirement and think it's maybe not enough. And what am I going to do? Put $100,000 into my kid's property when they have 40 years of earnings ahead of them, or keep it where I only have 3 or 4 years of earnings, he said. Why do you... I mean, here's the thing. Do you plan to retire, actually, guys? Do you plan to retire? That's a serious question. Do you expect to be able to retire? And, okay, I mean, there's retirement where you're meant to kind of stop work and just live this fantasy of sitting on your ass and, I don't know, going on, being a grey nomad, being bored out of your mind. Or there is retiring where you're financially independent and you have freedom over your time. And you still will work because you should enjoy it. And you've got flexibility. You know, there's two types of retirement. There's, I think, the fantasy retirement, and then there's reality retirement. Which should be better? I'd prefer the one where you're still working, but you've got control over your time and flexibility. That's kind of what everyone wants. I think that's more important than retirement. So, they, the children, have almost no prospect of repaying it in that time. The major risk is the parent could be left high and dry in retirement and the children won't be able to help. That's the biggest problem. If they've got nothing to decide. He said in the current booming property environment, there was a fear of missing out, which was likely to increase. So the bank of mum and dad was likely to be used more often. But here's the other thing. I mean, if you're in retirement, the kids could sell out or they could borrow money against some of the capital interest and then give that to their parents to pay them back. There could be strategies that you could use to deal with this if the property market is going to continue to grow up, if you get that capital growth. But, well, that's anyone's guess. But on a 40-year horizon, on 40 years, 10, 20 years, what do you think? So, they can give the bank a guarantee for, say, 20% for the deposit, and the bank will want a security. And they can back it up with a term deposit, but for many people, it will be through a mortgage. I don't think that's always a good idea, and that's the problem. It's when you lock up your house into it. He said a good alternative for parents was to allow their children to live at home rent-free to save for a home. And we're seeing some people do that as an opportunity. I mean, sure, you know, it's kind of going to be cramping your style there, and the dynamics of the relationship are going to be a bit frustrating, but that's part of life. You've got to deal with that. Multi-generational living is what's happened around the world for most of human history. At least now we're not all living in one room, everyone. He said it was a good idea for parents who did provide funding to make sure their expectations about repaying the loan were clear and written down. So there we have it, everyone. The Bank of Mum and Dad is nearly bigger than Suncorp Bank, but is ahead of Bank of Queensland with funding first home buyers. Wow. What do you reckon? I can't say I'm surprised, but there you go. So, thanks for watching, guys. Let me know your thoughts and opinions on this one. Would you go guarantee for your kids to get into a house? Or would you just give them the cash as a loan? Let us know. As always, thanks for watching. Please like, share, subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using affiliate links from Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, have a great day, and I will see you all next time. Bye for now.